Well, we were surprised, like the market. We had thought that the Fed was only going to have two cuts priced into the dot plot. So it's a welcome relief. But I think that you've had some new participants that's come on to the Fed, like Austin Goolsbee, and they're looking at what they should look at, which is more a mosaic of data instead of myopically focusing on this PCE core. We think that's a disaster and makes the Fed fundamentally flawed.
Disaster, really?
Total disaster.
Yeah, a lot of headlines.
What's wrong with core PCE?
The problem is you have to look. If you watch core PCE, then you'll end up being an incompetent Federal Reserve, and you'll call inflation transitory when it's skyrocketing. So what you should do is look at PPI, look at CPI-R, that's our index, or in other words, adjust the horrible shelter component of BLS, and then use something called judgment instead of a rule that Greenspan used to use, who was the real star of monetary policy. And so it seems like they've taken a leap and are using judgment instead of just focusing on this one measure that's massively flawed.
So which ones are, well, you just rattled off a couple of metrics there. Which one do you think right now has the most of a signal right now for inflation that you're really paying attention to?
Well, the reason that we've kind of nailed this cycle since the pandemic is that, unlike the Fed, we look at monetary policy, which drives housing market. And then we're lucky because we're energy investors. We have a pipeline fund. I founded a pipeline company. So I would argue, if you have those two inputs, you can ignore monetary policy. Just look at the housing sector and energy prices, and you will be a good forecaster. So right now, housing prices did come way down. They have ticked up. We talked about the last time. So that's a little bit of risk, but rents are low. So we might have to have yet another index that has just rents.
Yeah, like you said, you would not know that looking at the CPI index of shelter.
Or even our CPI-R is ticked up because Case-Shiller went up, but rents are down. Again, this is the mosaic you have to look at. So we do think that inflation is contained, and we are pleasantly surprised that the Fed seems to agree with us right now.
All right, Jay, make sure our headline writers are ready here. What have you done to your S&P 500 price target and why?
So we raised it this morning, and the best way to summarize why is a terminal command, MIPR, which I would recommend everybody boots up. We sort of sadly only figured this out about 2 weeks ago.
That's market implied policy rates for everyone tuning in.
Yeah, so if you look at one of the columns, it's a sea of red, but that's good red. So those are all the rate cuts that are priced into all the major bond markets in the world. And so it's kind of obvious this data should exist because we have it in the US, right? Because there's a futures market in every country. And so what's wildly bullish about this is that we were on 2 or 3 months ago, and we had this non-consensus call that the Euro economy was terrible.
Yep, you did.
And that the Eurozone would be forced to cut, or ECB would be forced to cut. But the good news is you don't even need to listen to our rationale because that's what market participants believe now. So I guess they're avid listeners of Bloomberg Radio. And also, if you hover over the Eurozone chart, you can put up a GPO chart, and you can see that it did plummet over the last 2 or 3 months. So this is the heart of the bull case. But it's even better because the ECB was very recalcitrant today and has what we think is kind of a crazy forecast of plus 0.8% for GDP next year, which we strongly disagree with. But the good news is you don't need to agree with our variant view on their economy because market participants in the Eurozone who trade Eurozone futures agree with us. That number did tick down a little bit. It was 144 is the negative, the cuts priced in next year. After Lagarde's speech, that ticked down 6 basis points. So it was a pretty hawkish speech.
All right, so let me just summarize what the good folks at your firm, Infrastructural Capital Advisors, did this morning. They raised your price target for the S&P 500 to 5,500 from 5,150. That's based on a 21.5 multiple on S&P consensus earnings for 270. So that's your 2024 year-end target?
Correct.
And for perspective, we're right now at 47.25.
Correct.
Right, so that's
okay.
Good.
Yeah.
What's the risk to your outlook here? Is it earnings risk? Is it macro risk? What are some of the issues you're concerned about?
What a lot of people don't appreciate is the multiple on the market is 90% driven by long-term interest rates. So the reason we upgraded it is that we had this non-consensus call that rates were going to drop from 5, but that looked a little bit problematic, so we were pretty conservative about 10-year. So, but at a 350, that implies a 21 times multiple on S&P EPS. And the consensus is 270. And by the way, we did this methodology last year and came up with our 4,500 target. So it's just a very straightforward, if you don't like, as you're pointing out, don't like one of our metrics, you can just plug in your own. We're using 3.5%, which implies 21.5 actually, and 270 on earnings. And we are bullish about earnings. And we think most people miss the dynamic that earnings normally go up by 10%. You don't need margin expansion. You don't need a very strong economy because companies are retaining earnings about 70%, invest about 15% after tax. That implies 10.5% growth. So the earnings estimates are normal, not crazy. And we don't think you need to debate that and wring your hands about it because it's the companies reinvesting their cash flow, primarily driving earnings.
So you had started off by telling us that the Fed and the dot plot yesterday indicated 3 rate cuts. You think that there's only going to be 2. The dot plot, though, there was a pretty wide range in there. You know, that's just the median with 3 cuts, but there are 8 participants who saw fewer reductions, 5 expect deeper cuts. We obviously don't know whose dot really belongs to who, but you could take a reasonably educated guess. Who do you think is really the voice that you're following the most right now?
Well, we think that the thought leader initially was really Goolsbee, that he came in and sort of said the emperor has no clothes, that the labor market is not the key driver of inflation. And I think that you got to the heart of the matter, is that Powell was probably forced to come off his tone because he had a number of participants saying that inflation is actually plummeting, that the economy is at risk. We think it's fine, but it is at risk if they keep rates. Because keep in mind, if inflation really is going down, then real rates are skyrocketing if you keep them flat. So it is encouraging that there apparently has been a little bit of a Powell's coup, and the hawks have been moved more to the center or even dovish.